Hi, it's Tim, and I have another question from a student. It says, Tim, why do banks do short sales? Well, when it comes to short sales, I thought the best way to answer this question is to first give you a definition, or at least my definition, of what a short sale is. So here's what a short sale is. A short sale is a lender's voluntary acceptance of an amount of money that is less than the amount owed to them as payment in full, so that the property may be sold as an alternative of them foreclosing on it. Therefore, the proceeds to the lender will be short of the original amount owed to them. So notice a couple things that I mentioned in here. First of all, a short sale is a lender's voluntary acceptance of an amount of money. So a lot of people, when a house is in foreclosure, they believe that they're actually, when they're doing a short sale, is that they're buying the house from the bank. They are not. The bank does not own the house. When a house is in foreclosure, the homeowner is behind in payments. They're in arrears. So the bank is starting a foreclosure process so they can get the property back so they can resell it. But when they're in that pre-foreclosure phase, and it varies from state to state, anywhere from maybe 45 days to sometimes a year and a half is that legal foreclosure process based on which state you live. But during that time, that pre-foreclosure time, some banks will accept an amount of money that's less than what's owed to them on the loan so the house can sell from the homeowner to a prospective buyer. So when someone is making an offer, as we as an investor, and we're making an offer on a house that's in foreclosure, trying to get the bank to accept a short sale, we're actually making the offer to the homeowner. And we sign a sales and purchase agreement with them, and then we submit that in a short sale package to the lender because that offer is contingent upon the lender's approval, because the amount that we're offering most times is less than the amount that the homeowner owes the bank on the house. So therefore, we need the lender's approval that they'll accept that amount of money to allow the house to sell from the homeowner that's in foreclosure to us as the investor. Now notice how I mentioned that it's a voluntary acceptance, because not all banks will accept the offer. You see, a bank is only going to accept a short sale offer if it's in their best interest to. You know, banks are in the business to make money. They're not going to accept just any offer that comes over to them because they're in foreclosure. See, banks go through a process. When a home is going through the foreclosure process, the bank is already figuring out how much they're expecting to net on this property if they do in fact have to foreclose on it. So in other words, they will go out and they'll get an appraisal. They'll see what the house is worth in its present condition, regardless of how much is owed on it. They're going to look, they're going to assume that they're going to be foreclosing and getting this property back and then selling it through a realtor after it's a bank-owned property. So they're going to go estimate what they think that they're going to be able to sell this house for if they do in fact foreclose on it and get ownership of it. Then they're going to deduct all of their cost, their realtor fees of selling it, their holding cost, from the time from today until they actually do expect to sell the property. So they're going to have what they call a BPO done on the property, a broker's price opinion. And then they're going to deduct all their costs that they're going to expect to have to pay, and then they're going to see what they expect to net on the sale if they do in fact foreclose on it. So this is called their net sheet. Now, when your offer comes in from an investor, when you made the homeowner an offer, they're going to look at what amount that you're offering, and they're going to compare it to what's on their net sheet, what they're expecting to net from the sale months and months down the road if they do take this house back and they do sell it through a realtor as a bank-owned property. And they're going to see which offer's higher. And they're going to make a determination. Is it better for us to accept this offer now and accept this short sale and approve it so this house can sell? Or is it in our best interest to hold out and reject this offer that came in because we're expecting to net more if we do in fact foreclose on it. So this is how the bank is evaluating each and any offer that you submit as a short sale. They're going to look at it and say, which way do we make more money? If it's by accepting the short sale, they will accept it. If they expect to make more money by actually foreclosing on it because they think they'll get a higher price down the road when they do foreclose on it, they will hold out. They'll reject your short sale and hold out and let a realtor sell it as a bank-owned property. So that's why a lot of people get frustrated when you're submitting offers over to the bank and you're saying, why won't the bank accept my offer? They're in foreclosure. Well, the reason they're not accepting your offer is because it's not high enough, and they're expecting to net more by foreclosing on the property. So I hope this information helps and clears up some things about short sales and why banks do them and sometimes why they reject your short sale offer. So we will see you next week when we have another video blog question. I hope this helps. Goodbye, everyone.